And we are broadcasting live officially from Providence, Rhode Island. My name is Nev. This is Money Matters, and today is Tuesday, December 8th. I had to check the calendar, I had to check the date. So today we don't have as sexy of the news as there is. There's a lot of pain and a lot of painful news that unfortunately I am bringing your way, but all comes with the good intentions, I promise. So today we're going to be taking a look at what some of the individuals around the world are looking at and predicting when it comes to our money, our economy as a whole. And I think that that's incredibly important to take a look at whether you are invested in equities, in bonds, in precious metals, in Bitcoin, in real estate, or you're not invested at all and just holding on to the job or hoping to get one. So we're going to be taking a look at all of that stuff. We also have some news of what's happening with the restaurant industry, not real estate, restaurant industry, although there's some news within real estate as well. So a lot of, not so positive news, a lot of negative stuff that we're going to be taking a look into. But I think this is incredibly important for us to consider as we're looking for ways to preserve our wealth and potentially grow it both short and long term. All right, y'all, let's do this. All right, and good morning, good morning, good morning. Welcome, welcome, welcome. Hope you're doing really well. If you are brand new to the channel, please do me a favor and subscribe to it if you like it. Also hit a like button, also known as thumbs up button or heart button or check button or a button that says, I really like this. And feel free to also hit the notification if you would like to be notified when we go live, or you can just, troll on the YouTube right around 7 a.m. every morning, and you should be able to catch us live. All right, so let's go in and take a first of the news, and it has to do with the current pandemic, and it's coming from who? It's coming from the World Health Organization. Who? Who said that? Who said? I could see a joke right there in there somewhere. But one of the things that is coming in is they're sharing with us life won't return to normal for at least 2 years. And I know everybody's excited about the vaccines, and you were like, yeah, this is going to happen by April, man. I'm going to be sipping latte in some sort of, restaurant, sitting outside in south of Spain, enjoying life. And you might be able to do that. But before you do that, let's take a look at what they have to say about the health. And then I also have some additional information for you if you're thinking about traveling, what that might mean, because they are developing something very interesting that I have been calling for months. And when I said it was going to happen, people said, you are crazy. You went on to the dark side. Here is your tinfoil hat. Well, tinfoil hats, it'll be for all of us. But here's what's actually happening coming in. Dr. David Nabarro is basically saying that the physical, I know they're saying social distancing, I prefer physical distancing, okay? Socially distant happened with the intent of internet. So physical distancing and masks are something that are going to need to continue as a way of treating the virus with respect for years. And he's basically saying that, reality is that we're not going to get everybody vaccinated in the time that people think is going to happen. It's going to take way longer. And we should be planning to supply ourselves with plenty of masks and plenty of patients around people or distance with people for about 2 years. The reality is there will be some months before we're able to dispense with all these precautions. And I don't think it's going to be months. I think it's going to be way longer, because who's going to get it first? Of course, people on the front lines and people that are deemed essential. Which, by the way, if you didn't know, the essential workers for the vaccine are also going to be banking and financial sector. That's right. The bankers, the bank tellers, everybody that works in the banks is considered essential. They will be the first ones to get it, right alongside with the police, firefighters, and the medical professionals. And of course, the traders. The traders will be the very next. But if you're saying to yourself, hey, wait, Nev, I sit by my computer daily and I trade on everything I can possibly find. Does that mean me? No, it doesn't mean you. I'm sorry to burst your bubble. I am sorry to burst your bubble. It's not going to be you. It's going to be the traders within the large trading companies. All right, another things that let's go in through some of the rapid fire news before we get into our deep discussion of what are they saying and why am I saying this won't end well. Because there's some really massive and dark clouds rolling in relatively quickly, so we better all run for cover. Major mortgage servicer Nationstar agrees to pay over $90 million settled claims. What happened? Well, Nationstar Mortgage has basically treating their customers badly. When I say badly, I mean fraudulently. When I say fraudulently, I mean folks that were filing for bankruptcies, they're being foreclosed on, and that's a big no-no. Can't foreclose when somebody is going through the bankruptcy proceedings. Sorry, Nationstar. I was going to call it Northstar. It's Nationstar. The other piece that they also didn't do is they were actually also alleging company filed to honor mortgage forbearance agreements and unfairly foreclosed on homeowners. So people were basically filing for forbearance, and they said, we don't recognize that crapola in the box. So sorry to tell you, but yeah, you are going to have to pay. Now, JCPenney's is emerging from bankruptcy, which is kind of cool and exciting. How did they do it, Neb? Well, they sold. And who did they buy them? Well, there are a couple of individuals or a couple of groups that bought it, and they did emerge on Monday. So that's yesterday. That leaves with Simon Property Group and Brookfield Asset Management Inc. Are the new owners and operators of the department store chain. And of course, that's kind of what happened. And this is exciting news, of course, for everybody, except there's one tiny problem. Since then, Simon was downgraded from A to A minus, and their stock fell 5.1%. Of course, they were downgraded by Fitch, and they were saying, you know what, you have too much debt, you have too many malls, and it's very questionable that these things are going to run and operate, so we're going to downgrade you. And downgrade they did, and of course, when they did that, the stock fell down. Now, is it going to go up? I got nothing, y'all. I am the world's worst. Whenever I tell you, something's going to go up, it's going to go down, because in this economy, everything is topsy-turvy, upside down, and so on. Now, the consumer applied for more. Well, thank you, Fox. That is quite lovely from you. See, they are thinking of us. Oh, I should probably adjust this because you can't see this. My apologies for that. Let's do this. Is this better? Hopefully this is better. Let's see. Yes, I see that it's better. U.S. consumers applied for more auto student loans but cut back on credit card spending. So we're no longer using credit cards, but we are getting back into the higher ed and borrowing even more. And of course, the auto loans are going on up. The borrowing rose 2.1% in October, and it was pushed higher by 4.8%, jump in category mostly made of student loans and auto loans. However, credit card borrowing did fall 6.7%. Now, this is very interesting because it also tells that, hey, some of the folks are maybe just getting in and trying to say, you know what, I don't have a job, I might as well go retrain. So they're going back to school. But the interesting piece is the schools are reporting less than normal number of students. That is weird. So maybe, just maybe, it's not more people going into it, but the cost of education is going up. I don't know. Let me know what you think and where you think things stand. Now, one of the things that is also important to note is that the consumer confidence fell in November, and according to a survey by Conference Board, potentially discouraging spending in the coming months. So winter is coming. It's actually already here. I'm pretty chilled, and today we're not getting above 32 over here in Providence, so it's really, really cold. But it's also going to be cold winter because when it comes to spending, and this is not the only space. We're going to be taking a look at the restaurants as well as some of the other problems that are coming our way. Now, economists closely watch consumer borrowing patterns to signal for how willing households are to take on more debt to finance consumer spending, which accounts for two-thirds of economic activity. So of course, for them to go in and say, yes, we think economy is going to turn around and it's going to be going well, well, that means one thing, and that means that more people are going to have to borrow and more people are going to have to buy. So that's an interesting piece to pay attention to. Now, we're going to switch over to Facebook. And Facebook, Libra slash DM, they're a little bit of a hot water happening. So let's go in and take a look at what's coming from Germany. And the German finance minister is calling Libra slash DM wolf in sheep's clothing. They're saying it will take more than just renaming Facebook's cryptocurrency to address the concerns regulators have about authorizing its launch in Germany and Europe. Relaunching Libra under the new name of DM was only a cosmetic change, and it doesn't address any of the challenges or issues that the regulators have. Now, one of the things, this is coming from the German finance minister, quote, "We must do everything possible to make sure that the currency monopoly remains in the hands of the states." Yeah, they are admitting it. They're admitting that they're printing. They're admitting that they are destroying. They're admitting that they're a monopoly. They're admitting everything right now, and it's not going to end. But before we go into the banksters and what they're admitting and what will or will not end and how this will all end, which I think is going to be, well, really painful. And I think that the current financial system, as we know it, as we have it, is not going to exist. Now, this is being signaled, of course, by the Economic Monetary Fund, the EMF, right? Where they were talking about the calling for Bretton Woods 2.0, basically calling for a giant, basically reset, right? Like, let's just go press a button, call it a day, let's start anew. But before we get into that, I am not done with Facebook because, as you know, they did rename to DM. And of course, the ministers and all of that stuff, they're not liking it. But there's another company that doesn't like it, and it's a London-based fintech company named DM. That's right. They are suing Facebook over the project's rebranding. So as you know, the DM is a London fintech startup that is threatened to sue Facebook and its partners for copying its name and has been preparing to take necessary action. Now, DM is basically dubs itself as a bank of things. It's kind of interesting. But what it is, it's basically an online pawn shop where you can go in and pawn off your goodies, get some cash, and they basically take it from you. And they are relatively new. They did launch in October of 2020. They do have about 500,000 followers on Instagram, I believe. And they are basically saying, you know what, they renamed, that's fine. But, you know, they either didn't do a proper research, which they would have found DM, or they did do a research and said, forget it. We are Facebook. They're a small startup. Who cares? We can take them over. Well, the little guy is standing against the Goliath. So go, David, go. Quote coming from the CEO of DM. We were flabbergasted on December 1st to find that Facebook's Libra Foundation has chosen to rebrand to DM. As a small startup, we are concerned that customer confusion resulting from Libra's action will significantly impact our growth. And, of course, it's going to be an uphill battle, but they're ready for it. They also said, we thought we'd concede and just say we are a small company, or do we fight for what's right? Legal experts advise the company to protect their brand, and of course, protect they will. A lawsuit might once again push Facebook's digital currency on hold, in addition to what we just heard come from a German financial minister, Ministry of Finance in Germany. So that's an interesting piece to know. Now, I did say that this is a very painful winter and more pain is going to come in. So now it's the time to enter the pain. Well, what are we talking about? First, we're going to go and visit the restaurant industry. Now, we've all known that they have suffered a great deal and they're continuing to suffer. Of course, they're not the only ones suffering, but here we go. We got to focus on an industry at a time. National Restaurant Association, NRA, which, by the way, I don't know that we should call it NRA, because when we have an NRA is the National Rifle Association. There might be a lawsuit coming over the acronym. Just watch out. But they did send a letter to Congress on December 7th addressing the collapse of more than 100,000 restaurants across the country. In just the last 3 months, the letter said more than 10,000 eateries have closed and thousands of others are in economic freefall. Most recent nationwide survey, most restaurants are experiencing a plunge in sale revenues, and more furloughs and layoffs are imminent. And of course, this all makes sense if you think about it, right? Because we started to sort of reopen, the summer kind of came in, then we hit the sort of that, Father's Day, July 4th, things started to roll down. We started to get into the fall. I've been calling it. This is going to be hugely problematic. And of course, the pandemic is continuing to rage on. They are shutting everything down. I mean, we are basically shut down. I can, again, once again, just like in March, count the number of cars that go down the major street of Providence on a fingers of one hand of what I see. Okay, it's not as bad as it was in March, but it's pretty darn bad. It's dead and it's quiet yet again. Not that it's been gotten crazy at all in 2020, but comparatively speaking, it's down. And of course, we're seeing more restaurants are being asked to reduce the occupancies, do outdoor dining only. Who the heck is going to sit outside at 20 degrees Fahrenheit, right? Or negative, 10 degrees Celsius, however you want to take it, right? Nobody's going to do that. So, of course, they are suffering. More than 500,000 restaurants of every business type, franchise, chain, independent, are in unprecedented economic decline. And for every month that passes without a solution from Congress, thousands more restaurants across the country will close the doors for good. 87% of full-service restaurants report an average 36% drop in sale revenue, an average profit margin on 5 to 6% only. It's of course unsustainable, and many of them are expecting to do even worse, potentially close the doors over the upcoming few months. Costs have not fallen by proportion level. 59% of operators say their local labor costs as percentage of sales are higher than they were pre-pandemic, and that makes sense because you have less customers coming in, but same amount of employees and maybe even more, right? Because now you're having to like spritz and disinfect things like crazy and kind of keep on doing this stuff. So that's something to watch out for. 58% of chain and independent full-service operators expect continued furlough and layoff for at least next 3 months. Restaurant closure and bankruptcies will continue to rise through 2021. 17% of restaurants, more than 110,000 establishments, are completely closed, and we are to expect that this number is going to continue to rise. The industry continues to deal with devastating impact of the virus pandemic. State and local governments are imposing strict indoor limitations on restaurants and even, in some cases, banning indoor dining, like we're seeing happening in New York City. I believe they're starting to ban it. It's not just the virus and draconian public health measures from the governments that restaurant operators have to deal with. Foot traffic to restaurants will start to plunge when outside temperature drops below 45. And of course, we are seeing this in New England right now as we speak. It's way too cold for anybody to want to sort of meander, and so maybe potentially you do an order in, or not even that. I am not seeing many order ins. I'm not seeing many deliveries like I used to see, and people are basically hunkering down, reducing on their expenses, and all of these things are very deflationary, very depression like. But of course, what is happening with the stimulus? Well, not much of anything. And again, I don't even know if it's a stimulus, if it's not meant to stimulate anything. They are still going back and forth. They still haven't decided on what's going to happen. The paycheck to individuals is not happening. That's more or less been confirmed by different news sources. They are putting in for potential that additional $300 payment, in extra payment for unemployment benefits. They are looking to potentially extend that. They're looking to potentially put some money towards schools and daycare centers, put some money towards local governments, and some of the other pieces that they're looking to do is to protect the renters yet again. However, this time around, it appears that they might take a slightly better methodology of how they're going to do it. And instead of just saying, can't evict anybody, screw you, landlord. Sorry about that, but that's just kind of the way that, they gave landlords middle finger. I don't know what to tell you. That's basically what ended up happening. They are right now talking about, wait a minute, we're hurting, especially smaller landlords. They're not hurting big guys. Big guys have access to cash. They can issue out bonds. They can tap into the things. It's the small guys that are suffering, if we're being completely honest. So that's one thing that they are saying, is that they might actually protect the renters by paying the landlords for the renters that haven't been able to pay. So kind of like a Section 8 version of things coming from the government. So that's kind of what's happening in the new plan, but of course, there's not much in it whole thing. Now, one of the things before we go in is that, well, I did want to go in, and we did talk about the whole planning to potentially travel and, enjoy yourself and the coast of some sort of beautiful town where it's much warmer where you are, or cooler if you are in a place where it's very hot, then you're thinking, I'm just going to hop on a plane because vaccines are coming. And yes, everything is a possibility, but another airline is announcing COVID passports will be essential for travel. So I've been calling for COVID passports. Well, I haven't been calling for them. I've just been saying that they're going to be coming, they're going to be requested, they're going to be essential. And of course, now we're getting information that is actually coming to fruition. So what has happened? Well, airlines have indicated that proof of vaccination through COVID passports will become mandatory in order to fly. The world's largest transport lobby group is developing a global COVID travel pass app designed to link vaccination status and coronavirus test results to a person's travel documents. COVID passports type system known as the Common Pass, sponsored by the World Economic Forum, is under development. There are additional passports being developed by technology companies, and some of them are already being tested, some of them are not. So we'll see that there's going to be a slew of these things, but do prepare that this is going to be widely tracked, widely monitored, and if you want to go anywhere, you will have to get a vaccine. You will have to go on the record. People will have to know it, and it's going to be in some way, shape, or form linked to your passport, linked to your travel documents, and that might be the only way that you can travel in the near future. And when I say near future, I mean we're probably, a few months away from that happening. So it will remain to be seen. Now, I do want to go into, finally, to talk about the big news of what is coming. Why am I saying this won't end well? Well, it's coming from the BIS. No, not the BS, although some people might want to call it that. BIS, Bank of International Settlements, Bank of Banks. And not just, central bank is the bank of banks, but BIS is the bank for central banks. That's right. This is like the granddaddy of the central banks. And they are issuing a dire warning. Quote, we are moving from the liquidity to the solvency phase of the crisis. And that is something that some of the more prominent economists, analysts, and macro guys have been warning about and have been talking about. So this is definitely coming, and we are entering the stage. The BIS warning about excess from monetary policy is coming, and coming strongly. The Basel-based organization, or Basel, Switzerland. The Basel-based organization did, in its quarterly review publication, caution that the surge in financial markets following COVID-19 vaccine breakthrough and the U.S. election has left asset prices increasingly stretched, sounding surprisingly similar to Goldman Sachs, which also issued an almost identical warning when it observed that its sentiment indicator is now plus 2.0 standard deviations above average. This is not normal, and if you were to actually take a look into the chart for those of you that are watching. For everybody else that is listening, I will do my best to translate the chart yet one more time. But what we're seeing is the U.S. equity sentiment indicator. And every time this puppy hits that plus 2% standard deviation above what the normal is, it ends up coming back down, and it falls much stronger than the previous indicators have fallen, and sort of pushes the prices down. So we've seen it in 2011 when it went, super high up, then came back down. Then in February 13, it went super high up, and then in 14, 15, and 16, we were predominantly down in those years. Then we have the November of 2017, we were up yet again. We did come down slightly in the late 2017, early 2018. We did hit a super high again in 2018 to go really low in 2019. And of course, now we're seeing this come to fruition yet one more time. The BIS quarterly report on Monday noted how credit market and some of the world's biggest stock markets has surprised their pre-pandemic levels despite the significant degree of uncertainty. And of course, they are very, very worried about what is going on and what is happening, and believe that this could turn into a massive problem in the upcoming months. And 2021, as many people are very excited about it, could be even more painful than 2020. One of the developments it was particularly worried of was the rapid easing of stress in corporate credit markets, which recently culminated in record low junk bond yields. You can see that the Bloomberg Barclays High Yield Index is turning down to the worst. We are moving from the liquidity to the solvency phase of the crisis. Translation: it's about to get much worse. Only because central banks will ignore all the warnings, they will double down on the same failed policies, pushing leverage to even recorder highs, yields to even recorder lows, and sparking a propagation of zombies, the likes of which we have never seen before. Well, one of the things that is kind of interesting is that there is the liquidity crisis and the solvency crisis, right? And typically, when the problems begin, it begins as a liquidity problem. You don't have enough cash to be able to do what you need to do. So, of course, if we're able to pump in cash into the economy, we solve for the liquidity part of the equation, part of the problem. However, when you have way more debt than you do the income to be able to cover that debt, and you're not able to kind of pay your obligations, that's when you start hitting the solvency crisis, right? It makes perfect sense. You went out, you borrowed a little bit too much, you used that money to be able to finance whatever you needed to finance, to be able to pay whatever you needed to pay, and now you're coming to the end of, crud. In order for me to pay what I have borrowed, I actually have to borrow more. But if I borrow more, I will have an even harder time paying. And many of us individually have found ourselves potentially in one of these money problems, as I like to call it. There's lots of money problems that are happening. The good money problems, the bad money problems, the problem problems. But whether you have a lot of money, not enough money, too much money, don't have any money, all of those are money problems. They're just different kind of a problem. And so what many folks have found themselves, and Lord knows I have as well, to be completely honest with you, is that you find yourself not having enough money. So what does that mean? Well, you have to go and borrow money to be able to afford what you need to pay. But now you have this credit card debt over here that you can't really pay and take care of, so you got to borrow more money in order to take care of this guy. And now you have two debts, and you're like, oh crud, I need to borrow more. And at some point you borrow so much that you can't afford to pay any of them, and you end up hitting the solvency crisis, meaning you can't afford anything. You gotta go through the bankruptcy. This is what they're warning about, and we're not talking on personal level, we're not talking on a corporate level, we're talking on a central bank government level, which is the reason why I keep saying that the financial system as we know it is coming to an end. It's the world is not gonna come to an end. Okay, well, I mean, I guess it might someday, but what I'm saying is that this is not gonna make the world come to an end. It's just going to make very painful changes for most of us, whether we are on the top, on the bottom, and of course the bottom part is going to suffer way more than the top part, as always. We should be expecting more bankruptcies going forward, yet credit spreads are quite low by historical standards, and indeed, while banks are pricing risk more carefully, we don't see the same in capital markets. With $17.5 trillion worth of bonds now carrying negative yields, many money managers were being pushed into riskier and riskier assets, and many of them are jumping into equities. And equities are in a huge problem. Equities are in the giant issue with being super highly overpriced, with the companies being over leveraged, many of them buying their own stock shares in order to boost the pricing in it. And so some of them, of course, are profitable because they're doing stuff, but that is not the case for vast majority of them. But now we're seeing the vast majority of stocks are in the highest of the prices. Everybody believes that it's the right thing to be in. Everybody's jumping on that train. And when we see all of these things happening, that is when potentially the risks end up being higher. But not every company is jumping into the equities. Some companies are looking to add extra cash positions onto their treasuries. Some are looking to add gold. And then, of course, we do have some that are looking to add Bitcoin. And then there's very, very few that are saying, you know what, I'm going to do all of it. I'm going to do a little bit of this, a little bit of this, a little bit of this, and protect myself long term for all of these different things. But those are few and far in between. MicroStrategy, as you know, already has 40,000 something Bitcoin, and they're looking to buy even more. Well, how are they going to do it? They're actually issuing a bond to buy more Bitcoin. Do I think it's a good idea? Well, I am not them. I don't understand their business completely. I haven't seen their books and stuff. But I do see this kind of getting a little bit into the crazy factor of things, which makes me think, time to pause for a moment, because we are seeing what we've seen with the retail getting a little bit on the crazy side. We're seeing potentially with some of these companies getting a little bit on the crazy side of now borrowing money in order to be able to buy Bitcoin. I don't think that that's a good idea, but then again, I think Michael Saylor is going to either turn into a genius or an idiot. We just don't know which one quite at this moment. Now, one of the things to note is that the Bitcoin price is losing critical technical levels, and it is under pressure. So it is losing on its dailies and the weeklies as well. And right now we're just going to take a quick look into the crypto market and find out where we are. We're actually breaking down below some of the support levels that we've seen, potentially could be pushing Bitcoin and other cryptos even lower. So Bitcoin is currently sitting at $18,647.27. It is down 3% over the last 24 hours and down almost 5% in 7 days. Ethereum is losing a bit more, negative 4.1% in 24 hours and 6.5% over the course of 7 days, with $570.40 being the current price. And of course, if we scroll down, you will see it's red. I mean, everything is red. Okay, not everything. I think we have a few things in the green, and of course we have a handful of things in the green, and then we get into the red. Who is in the green? Well, SDX Synthetics is up 13.5% over the course of 24 hours. Comp is up 15.1%. Should have been up above it again. There goes that. Comp is 15.1% higher. Band is slightly higher at 1.7%. Phil is, or Filecoin is up 1.6. Nexo 1.7. Luna 1.5. DAI is in the green. I mean, the stable coin is in the green. That should tell you something. When we see that predominantly in the green is the stable coins, we know we have something bigger on our way. And nothing that is hugely lost. The biggest one is M is negative 12.3, Rune at 10.1, and then it gets into the single digits. But aside from those couple that I mentioned, including the stable coins, everything is in the negative. So as you can see, the crypto market is definitely in the negative, and we'll see how it's going to go. It is wise to pay attention to it. Could it dip 20-30%? Yes. Some of the support levels are going to be some of the previous resistances, or of course previous support levels. We'll see if it gets there, and if it drops there, it could potentially drop as much as 30-40%. It's done that in the past. And we are expecting probably the best, sort of the lowest, I guess, holding methodology to be right around 13,000 or so. Even if it drops, I mean, if it drops below that, it's probably going to go even lower, potentially. We just don't know. But there might be some good opportunities, buying opportunities coming our way for long-term accumulation. So if you believe that this train will continue to rise, well, there might be some gifts coming our way where you can buy it at a much lower price. So there you go. That's it for today. I hope you have enjoyed the show. I hope you have learned something new. I hope you're petrified to the bone. Actually, I don't hope you're petrified, but there's definitely some news that are not so pretty, and I think it's important to understand those and figure out ways to protect yourselves and protect your wealth. I do believe in long-term investing. I do believe in holding hard assets. I do believe in diversifying a little bit, not a lot, but a little bit, into things that just make sense. I do believe that, getting yourself out of the market that is so overcrowded with everybody on one side of the boat might make sense, and look to position yourself in the market that is potentially up and coming, with cash likely to shift to it. So thanks for watching. Until next time, stay forever money blessed, and to remember, you are only one